Hi everyone, welcome to today's video. So on today's video, I am going to show you how I have invested approximately 10 lakhs across 3 different stocks. But in total, I am going to talk about 5 stocks in particular in consumer durable goods industry. Now, why am I bullish on consumer durable goods industry? Please watch this video. I have done an entire industry overview. But just very quick recap for people who are just joining us and they have not watched that video and they don't want to watch that video. Very quick recap for you. Why am I bullish on consumer durable goods industry? Is very simple. A. The middle class of India is growing at a massive rate. By 2025-2026, India will have the highest population number-wise in the middle income category. So that is one. And middle class people buy a lot of TV, fridge, AC. So it is very likely that these consumer good focused stocks are going to excel and might become the next gold mine. So that is one. The second key point about consumer durable goods industry is that the operating profit margins in this industry is likely to go up. That is something that I will explain to you by helping you understand finances, charts, graph. I'll explain it in super simple manner. If you like my explanation style, please press the like button. That helps a lot with the YouTube algorithm, makes me super happy. So please do it. Please do it now. Okay, with that said, let's get started. I'm going to show you live investment that I have done approximately 10 lakhs. So let me very quickly show you across which 3 stocks I have invested my money.
So these are 4 stocks on which I have traded today. So you can see that I initially bought HUL. I made a separate video on HUL as well, that I bought this stock for trading purpose. So I sold this off, made good 9% returns, and rest 3 are Whirlpool, JCHAC, Symphony. I have already purchased Voltas in the past, so I did not buy that more. So you can multiply average price by the quantity and you will get the total amount, which comes out to be approximately 10 lakhs.
So I have purchased these stocks last Friday and I also sold HUL. From one of my earlier videos, I categorically mentioned that I bought HUL for trading because the technicals were saying that it will give a breakout. So it gave a breakout. I sold it, made 8-9% in a matter of a week and moved on. Now I am going to go stock by stock and tell you why am I bullish on these 4 specific stocks. Very quick note, I have not bought Voltas last Friday. This is a stock that I already hold. Since we are discussing consumer durable goods industry, I feel that this again is a very good stock. Please note that this is not an investment advice. Please do not consider this as an investment advice. Even if you don't listen to this disclaimer, you purchase the stocks. Please do it from a long-term perspective. These are not trading stocks as of now. The first stock that we are going to analyze, it's called as Johnson's Control Hitachi Air Conditioning India Limited. It has a very bhari name. Essentially, they are Hitachi, right? They produce ACs and it's a joint collaboration between Johnson's, which is an American company, and Hitachi, which is a Japanese company. So they have come together, created a joint venture in India, and they are creating a brand called as Hitachi. Now, why am I bullish about this stock? So let me just quickly take you through the financials. There are a lot of positives and negative things that you will see, and I'll come to that in a minute. But let us quickly take a look at financials, right? So essentially, over the last 3 years, the net income has been positive, right? It grew, then because of COVID, it fell and it has been falling. But essentially, there is no problem in terms of revenues, especially if you factor in the COVID crisis. Very important point, and this will be applicable across all the stocks that we are talking about today, that due to COVID 2020, what type of stocks would have suffered the most? Now, a wide range of stocks would have suffered, but consumer durable good industry stocks would have also suffered a lot. Why? And here is an important economic concept to note down, that when crisis happens, especially financial crisis happen, or the economy is shrinking, then what usually happens is that people cut out their discretionary expenditure. Now, what is discretionary expenditure? So discretionary expenditure would be that they will spend less on luxury items. They will spend less on anything that gives them comfort, so to say, right? So, for example, they will postpone their decision of buying a TV, fridge, AC, especially when people are losing jobs. So because of which the consumer durable goods industry had suffered a lot in this pandemic. It still continues to suffer. But as we will see, that this scenario is likely to change very, very quickly. So with that said, when you're reading the balance sheet or income statement of any of these companies, please keep this in mind that COVID-19 has proven to be a major pain point for these consumer durable good industry, and rightly so, right? So it's not company's fault here. Truly, it was a type of a crisis that would hurt consumer durable goods industry. If their share prices have come down, it has come down for a reason. And the reason is COVID-19. I do not keep on blaming everything on COVID-19, but this is one video where I'll blame a lot of things on COVID-19 because of the nature of the consumer durable good industry. So with that said, let us take a very quick look at the overview of JCHAC. So the market cap is small, right? So it's not a very big company. Debt is 12%, right? So debt is slightly high. So that is a slight problem. If you take a look at ROCE, again, it's low, right? I'll come to it in a minute that why these are not a massive problem as of now. So let's look at quarterly results, then we'll move forward. So you would see a few key patterns, right? So up until March 2020, things were looking fine, right? It's not as if that there was a major problem. Now with JCHAC, you need to note down the fact that this is a relatively new venture. It's a small cap company. It is new. It is trying to undertake capacity expansions. Now how you can check it? If you take a look at its balance sheet and if you take a look at fixed assets, you will see that their capacity, that they have been expanding their capacity increasingly. So capacity expansions essentially mean that, hey, it's a small company. It is trying to expand its capacity so that it can manufacture more electronic good and sell more of it. So which is a good sign. It's a sign of a healthy company that they are undertaking capacity expansion. And this is a type of a fixed cost business. What it means is that, for example, JCHAC, if it has 5 factories across India, hypothetically speaking, now if it has increased its fixed capacity, maybe now it has 10, 15, 20 factories, right? Now, over time, they will slow on this, right? Because they will churn out more and more units. They will improve the productivity of every factory. So bottom line is this fixed cost expenditure will get subsidized over time, right? So if a company in the consumer durable goods industry is taking capacity expansion, especially fixed asset capacity expansion, it's a good sign. It's not a weak sign, it's actually a very healthy sign. And for this, and this is the reason why the ROCE, return on capital employed, what is ROCE? That if you give a company 100 rupees, how much return is it making? So in Hitachi's case, it's approximately making 5.5 rupees as return, which is not great as of now, but as capacity expands, there will be economies of scale. So this ROCE will improve with time. Now here is like another key trend that I'm going to show you, and it's the holding pattern. This is again a worrisome sign for a company like Hitachi. If you take a look at shareholding pattern, you will see this yellow tab, right? It shows pledged holding, right? So pledged holding means that the company has pledged its share. For what reasons? For getting more money so that it can then take that money and go and expand and undertake more capacity utilization, get more contracts, export more, build more partnerships. Essentially, it's very similar to us mortgaging our house for a loan, right? So companies also mortgage their company shares for a loan, which is a worrisome sign in some cases. But in Hitachi's case, you should not be too worried about this as of now. Why? Because if you actually take a look at the total promoter holding, it has stayed consistent. Promoters have not decreased their holding. And if you actually click on all these tabs, September 2020, December, March, June, what is happening is that this pledged holding has come up recently. Right, so it's not very old, and we see an associated increase in capacity utilization, right, or the capacity expansions is taking place. So this pledging or loan has been taken for good purposes. So I always say one statement that, hey, debt can be good and debt can be bad. So this looks like a good debt, especially if this allows them to generate more sales. Now here is the industry insight, and this is something that I hope that you would all be able to see it, and this is what separates people who make money in the stock market versus not. So here is a key insight that you need to observe. Now why is it that you see this shareholding pattern changing and this pledge holding going up in June 2021? Now the answer lies in quarterly results. Now if you take a look at the quarterly results and if you take a look at last 2 quarter sales, what do you observe? That since June, if you take a look at June data, because that was impacted by coronavirus, so from 2070 to approximately 500, that is where sales are standing. So we have 2x our sales. So sales have become 2 times, right? Which is good. In a span of 1 year, sales are increasing. This is just a matter of time that sales will literally explode, because even now the impact of coronavirus is there on consumer durable goods industry. So if, let's say, if we are sitting in June 2022, June 2023, what do you think the sales number will be? My approximate guess is that this will go up to 800-900 crores. And that is the point at which this ROCE will improve, this operating profit margin will improve, which is massive. And this is when the share prices will skyrocket. So if you don't have the capacity to hold this stock for at least 2 years, you will struggle. This has answer to all the things that we have discussed, that why have promoters pledged their shareholding? Because they want to undertake capacity expansion so that they can sell more ACs and more units in the next 2 years. Because why? Because there has been a pent up demand, right? For the last 2 years, people have not been buying fridge, ACs, TVs. They will go in the market and start looking for great deals. So it's very important for these type of consumer durable good companies to have their logistics and production sorted out. So that is the reason why all stocks that I am discussing today, they have great potential. So this brings us to the final point, that what is a good entry point for JCHSE. Now this is the chart that I will enter for you. So let us look at the data for the last 1 year, and you can see that this is the 200 DMA and the stock is trading much below that, right? So it was trading at 2300. A recent fall has happened. It's at 2100 approximately now. So this is a good entry point according to me. Can the share price fall more? So ideally the stock should not fall further more, because it is finding a great support level here, right? So this has been the support level. So it has a great support level at approximately 2100 levels. So I don't see the stock falling much below this. So I feel that this is a great time to enter this stock. Again, please do your due diligence. This is not an investment advice. So if you like the analysis, humble request that please press the like button. And now we move on to the next stock. Now next, let's take a look at Whirlpool. Now Whirlpool, all of us are familiar with, or at least all of us would have heard the name, right? I use Whirlpool products. My mom loves Whirlpool washing machine. So we are all aware of the brand, right? So let's quickly take a look at the financials, that what is happening with the company. So the sales have been growing up, and it is a good sign for a company like Whirlpool. The net profits have somewhat stagnated. Again, it can be attributed to the COVID problem. Now let's quickly take a look at the quarterly results as well. Now you can see that post March 2020, the profits have not gone up massively, right? There was just one quarter where the profits went up because the first wave of coronavirus was somewhat addressed, and post March 2021 again we got into like the second wave, and again the operating profit has been coming down. And same problem, this is the same problem that you saw with Hitachi as well, that the operating profit margins are low. Why? Because again the same point, capacity expansion. How you can check it? If you go to their balance sheet, and if you check at the fixed asset, again Whirlpool has also expanded their capacity. Now this is a very important point, because if companies like Whirlpool, Hitachi are expanding their capacity, what does that mean? It simply means that, hey, you know what, they are anticipating more sales coming in the future. They want to be future ready. They are willing to place their shares to meet that demand. So this is a good sign. This is not a bad sign. This is good debt. If these companies are taking on debt, it's not a bad sign, because this debt is temporary, and in another 2 to 3 quarters, there is absolutely no sound reason why the sales of these companies should not be going up. Another important point to note about companies like Hitachi, Whirlpool is that these are seasonal businesses. Now the quarterly results that you are seeing the sales number at 1341. So in the next quarter, because it is still summertime, the results will be at least equal to this. At least. My assumption is that it will at least go up by 20%. And starting next year, of course, given the coronavirus pandemic, we don't know what the third wave will entail. I'm hoping that it will be a light wave. If that's the case, so these stocks will start hitting their all-time highs in another 1.5 to 2 years. That is what my assessment is. Now, if you actually go on Tickertape and if you try to look at the forecasts that have been built, now this low forecast, I believe, now of course the rationale is not given here, but I believe that this is assuming a very high impact of COVID wave 3. So this is unlikely to happen. My assumption is that by 2022, this will definitely give approximately a 35% return. That is what I am betting on. And I am betting big on something like Whirlpool because of that reason. It's a stable, safe company. There are no quality check issues. Default probability is also low. So compared to Hitachi, this is a slightly safer share. So if you're a moderate type of an investor who does not want to take too much risk, invest in Whirlpool. Hitachi is a good stock to buy now, but for a slightly more risky investor. If you're a slightly more conservative investor, go with Whirlpool. Now, if you take a look at the technicals of Whirlpool, it is trading well below its 200 DMA, right? 200 DMA. There was a very strong support level at this level, right? Which was 2100. It's trading below that, right? It's forming like a new low, so to say. So I don't see it falling much below than this. Right now, almost all the mid cap, small cap stocks are taking harsh beating. It has come down below its support level because of that harsh beating, not because of the fact that there is something fundamentally wrong with Whirlpool. It's a good company, good brand, good sales prospect. They themselves are expanding their capacity. So I feel quite comfortable given all this scenario to invest in something like Whirlpool. Now the third stock that we are going to analyze is called as Symphony, and I feel that this is a really strong stock with supreme upside potential. Now why am I saying it? So very quickly, let me show you the 5-year chart of Symphony. Back in January 2018, so approximately in 2018, it was trading at 1700 to 2000 approximate levels. Right now, it is trading at 900, right? So it's approximately has dipped by 50%. Okay. Now let's take a very quick look at the consolidated financials for the company. Back in March 2018, what were the results? The results were, or sales were approximately 800. Now the trailing 12-month profit has been more than that. Let's say operating profit was 220. Trailing 12-month profit has been 154. Not very far away, especially given the price decline that has happened in this stock. Now the question would be that, hey Akshat, then why is it that the share price has fallen so much for something like Symphony? The answer lies in operating profit margin, right? So the operating profit margin back in 2017-2018 was approximately 30% for Symphony. Right now it has gotten literally by half, right? So if the profit margins shrink, then of course the share prices will take a beating, especially if the market is reacting poorly to it and if it believes that Symphony will not be able to go back to its profit margin levels. Now what did we see from the other stocks? Is Symphony undertaking capacity expansion? Massively, right? Now if you take a look at the last 3 years, so the fixed assets have been going up massively. What does this indicate? This indicates that the firm is undertaking capacity expansion, which is a good sign. With this, the profit margins have temporarily gone down and they will come up like it would be for all the other good consumer durable good companies. So this is the reason why I'm betting big on Symphony as of now. This very simple analysis should help you understand the picture. Please press the like button if you enjoyed the analysis. Now let us quickly check some key parameters on Tickertape regarding default probability and forecast. So there is nothing fundamentally off about the stock. Default probability is very low. Growth scores are high. Quality wise, this company is really good. If we check the forecast, what is the expected forecast? It's approximately 58%, 35%, good growth prospects. And these forecasts make a lot of sense for me. The only reason why this company might not be able to perform well might be the third wave of coronavirus. If people push their decisions to buy consumer durables further, then of course all these companies will suffer. But personally speaking, I do not see coronavirus third wave creating havoc in India from a business point of view. So therefore I am betting big and I at least see 35-40% potential in this stock. Now why am I saying it? So I'm not buying these stocks for the short term. Therefore, I'm not too much into technical analysis on these because I'm fundamentally analyzing it and buying it. If you want to trade these stocks in the next 6 to 8 months, there are some good patterns forming. So let me just quickly explain that as well to you. So this is called as cup and handle pattern. So let me just quickly explain. This is the cup, right? And this is the handle, right? So essentially, this is the depth, right? If you take this depth and stick it above this, it will come out to at least 1700-ish level, right? So this is where it should be trading in the next 8 to 10 months, right? This is the rough time frame that I'm giving for these stocks. It might not happen, but these are what the technical parameters tell us. Now, right now, the stock is trading at 911. It is much below its 200 DMA. Great time to buy this stock. Again, very close to its excellent support level. So it can give a breakout at any juncture. Likely it's going to happen that people are going to wait for a couple of quarter results and then these stocks will become rocket, right? Now, the fourth and final stock that I have bought in consumer durable goods is Voltas. I don't need to speak too much about the company. We all know that Voltas is a great company, but let us just quickly analyze some of the key results. The results have been good for the company. Nothing majorly off. The net income has been high. Nothing majorly off. It has somewhat stagnated post the 2020 crisis, but it is still very stable. Unlike other consumer durable good companies, Voltas is still somewhat stagnant in terms of its net profit. It has not come down. Let's very quickly take a look at the quarterly results. Now you can see the net profits actually skyrocketed. It became 238. Post the first wave of coronavirus, then second wave came in, people stopped buying consumer durable again and the profits fell again. Now, when the impact of second wave will be completely taken into account, these stocks and these numbers will again become very high. There is absolutely no reason. The company has grown excellently. I am betting big on this company again. Is it available at a good price? Let us take a very quick look. Now, again, you can see that it is close to its 200-day moving average line. Very strong support level at approximately 950. It's trading at 977. So good time to buy according to me because this is not a stock that should fall like something like Symphony or Hitachi. Now many of you asked me to comment on a fifth stock which is called as Amber Enterprises. Now this is an OEM. It actually manufactures a lot of equipments for the major AC lines in India, be it LG, be it Whirlpool, be it bunch of other stocks that we have analyzed. Now I am betting directly on brands because brands have branding power. As you might have seen that all the 4 stocks that we have analyzed, right now their ROCE, return on capital employed, is low, right? But as the brand grows, because these companies are still fairly young, they are undertaking capacity expansions. As they grow, as they sell more units, they will become unit cost efficient, and that will play into their ROCE. So therefore, I'm betting big on brands because brands have pricing power. So on yesterday's video, I had asked you a question. Now, what do you think is the profit margin for Apple iPhones? It was close to 40%. Why? Because Apple is a massive brand, right? I'm betting on brands because right now their ROCE is less. So they will explore every option to grow that ROCE by using their branding power. So I'm betting on these front-end players rather than these back-end players. Therefore, I'm not investing in Amber Enterprises. It's a good company, financials are fine, but I'm not going to do a very extensive analysis of Amber Enterprises because I myself have not invested in that. But I just wanted to make a simple point that I'm going with brands. I'm not investing in OEMs. That does not mean that it is a bad stock. It might be a great stock, but that is not the bet that I'm willing to make because in the long term, I would rather bet on brands. So in short, if you're a conservative investor and you don't want to take too much risk, then something like Whirlpool and Voltas are great buys for you. If you want to take slightly more risk, then Hitachi and Symphony are great bets for you. They can give massive returns. I would rather split my money and invest in all of these 4 stocks because when these companies grow, we don't know in what disproportionate rate these companies will grow and how their market share will grow. So it makes sense to take a bet on all of these and split your money accordingly. So I hope you enjoyed this analysis and I will see you the next time. Please give it a thumbs up and a comment. That would mean a lot to me.